Welcome to The Explainer. Today, we're digging into the latest earnings from JPMorgan Chase. And let me tell you, it's a fascinating story. You've got record success on one hand and a puzzling stock drop on the other.
Okay, so let's just jump right in. JP Morgan just posted its most profitable year ever. Yet, the market turns around and pushes the stock down. I mean, how does that even make sense? Well, to figure it out, we've got to look way past the headline numbers.
You see, to solve this little mystery, you have to understand that the number that first got everyone's attention, well, it doesn't really tell the whole story. There's a really crucial adjustment we need to make.
So, on the surface, what did they report? $13 billion in net income. But, as CEO Jamie Dimon was quick to point out, the real number, if you just pull out one single massive item, was actually $14.7 billion. That is a huge difference, and it all boils down to one gigantic bet.
So what was that item? It was a massive $2.2 billion charge. It's a provision for credit losses, and it's all tied to their blockbuster deal to take over the Apple Card portfolio from Goldman Sachs. And believe me, this is the key to the entire story.
And that brings us right to the core of the market's reaction. JP Morgan's high-stakes, super high-cost bet on its new partnership with Apple. Is this a brilliant long-term play? Or is it a costly mistake, especially when you think about what happened to the last bank that tried this?
The accounting here is, well, it's a little tricky, but it's so important. That $2.2 billion, that wasn't a loss from bad loans they already had. No, it's this thing called a forward purchase commitment. It's basically an accounting rule that forced them to set aside a huge pile of cash for losses they might have in the future, before they even officially own the portfolio. So it's this giant upfront hit to their profit before they've made a single dime from an Apple Card user.
And this has created a really sharp debate. You've got the skeptics, and they see this huge upfront cost for a business that, let's be honest, reportedly cost Goldman Sachs billions. But then you have the optimists. They argue JP Morgan is just taking its medicine now, getting the pain out of the way so they can lock in this massive, super valuable customer base for years to come.
The skeptics? They're pointing to the sticker shock of this whole deal. And it's not just that initial reserve. Management also warned that their adjusted expenses are set to balloon to a staggering $105 billion this year. That's a 9% jump, and a lot of that is to handle this new integration. But the other side, led by CEO Jamie Dimon himself, they argue this is exactly the kind of big swing a bank of their size should be taking. He's basically betting that their famous fortress balance sheet, which is just their way of saying they have tons of capital and stability, will let them win where others have struggled. Okay, but here's the thing. While the market was totally fixated on the Apple deal and all these rising costs, something else was happening. The bank's core engine room was absolutely firing on all cylinders, putting up some really massive numbers.
Just take a look at their markets division. That's their trading arm. It had a monster quarter. Revenue just surged 17%, thanks to a ton of client activity. I mean, this division absolutely carried the firm.
And this just brilliantly shows their unique strength. Even when other parts of the bank, like investment banking fees, were kind of soft, their dominant #1 ranked trading desk just picks up all the slack. It's this powerful buffer that lets them swallow a $2.2 billion hit and just keep on moving. And this strength wasn't just a one-off thing. I mean, you look across the board, the numbers were strong. Their payments revenue, a record $5.1 billion. They added millions of new consumer accounts, grew their wealth business. The underlying company is just incredibly robust.
So if the business is so strong, why is the CEO himself sounding, well, a little cautious? This is where you have to kind of read between the lines of his official comments.
In his statement, Jamie Dimon basically described two different worlds. He said, yeah, the U.S. economy is strong right now, but then he warned that markets are underappreciating some serious risks out there, everything from geopolitics to the chance of sticky inflation.
And doesn't that reflect the bank's own situation almost perfectly? You've got this core business that's strong and resilient, but at the very same time, they are proactively taking on this huge, very visible, and very expensive new risk with the Apple Card. So is Dimon's caution about the economy just him being prudent? Or is it maybe a reflection of the big gamble they're taking right now?
So the crucial point is that all of this leads to two very different competing stories about JP Morgan's future. And right now, the market is trying to figure out which one of those stories it believes.
On one side, you've got the bull case. The bulls see a financial powerhouse that's worth $328 a share, just humming along with strong fundamentals and smart investments. Then, on the other side, you've got the bear case. They see an overvalued stock, maybe worth $247, that's going to get weighed down by rising costs and the risk of this new credit portfolio. That is a huge gap in how people are valuing this company.
So ultimately, that 4% drop in the stock, it wasn't really about any current weakness. It was all about the massive cost and the perceived risk of ambition. And it leaves investors with one huge question. JP Morgan is betting its entire fortress-like reputation on this deal with Apple. Will it end up being their smartest investment ever, or will it be the first real crack in the armor?